issue is the primary market. So primary transactions are where the issuer receives the proceeds. All of those transactions together are called the primary market. And, you know, the biggest thing here in the primary market is what we call the Act of 33. You know, sometimes you can get questions right by covering up the screen and saying, are they asking about prospectuses, paper? Or are they asking about people? You know, that would be 34. So 33 is about paper, prospectuses. 34 is about people and places, right? So new issues is 33. And 33 basically says, if you're going to sell brand new securities, this is huge. Brand new securities. What kind of securities? Brand new. To the public. To whom? The public. You have to make a registration statement with the SEC. Right? So that's what this says. And this is, you know, not testable, it's called an S1. But, you know, you're going to make a registration statement. You're telling the SEC that you plan on selling brand new securities to the public. Now, remember, when we passed 33, we had some exemptions. We have exempt issuers. And we have exempt transactions. So to say you're an exempt issuer means you don't have to make a registration statement to sell brand new securities to the public. That's what it means to say it's an exempt issuer. Very testable. Exempt transaction means the way you sold it is what means you don't have to register it with the SEC. So very testable. Who are some exempt issuers? Who is allowed to sell brand new securities to the public without making a registration statement? By the way, this is important as well because this also means that these securities that have gone through this process are called registered securities. You know, it's kind of like learning a foreign language. They say when you dream the foreign language, that's when you know it, right? And then securities that have not gone through this process are called unregistered securities. All right, anybody know any exempt issuers? So the state administrator or the SEC says, Dean, did you sell a brand new security to the public without making a registration statement? I said, I did, but it was a treasury bond. Neener, neener, neener. Don't suggest you say that. The U.S. government is an exempt issuer of securities, meaning that the U.S. government doesn't have to register its securities with the SEC to see T-bills or T-notes or T-bonds or Ginnie Maes or Fannie Maes or Freddie Macs. They're an exempt issuer. Right on, Wendy. Wendy, you nailed it. Munis. So again, the state administrator says, Dean, did you sell a brand new security without making a registration statement? I said, I did, but it was a municipal bond. So municipalities are exempt issuers of securities. Now, you were talking about documents. This is important. You know, most of the time people buy new issues, they get a prospectus because that's where we're heading. If we're assuming we're not an exempt issuer, assuming it's not an exempt transaction, there's going to be a prospectus. And, you know, we just said the municipalities don't have to make registration statements. They don't have to give people prospectuses. And so municipalities are going to use test question and official statement. Yeah, we can, Wendy, pull up that QID before we call it a night. I'll pull that up for you. Okay, so what are some exempt transactions? What are some exempt transactions? So the SEC says, Dean, did you sell a brand new security to the public without making a registration statement? I say, I did. They say, well, Dean, what safe harbor did you avail yourself of? You know, when you're asking an attorney about a safe harbor, you're asking, how can I do this without getting in trouble? And I say, I used a Reg A offering. A Reg A offering. So that means I don't have to register it if I'm using Reg A. That's a safe harbor. And with Reg A, I can raise up to test question. So Wendy, how much money can I raise using a Reg A offering? We can raise up to $75 million. Well, another exemption we have, very testable, is Rule 147. You know what Rule 147 is?
Is that about quibs?
Well, no, that's not. That's good news. You got it up there. This is an interstate offering of securities. And to use this one, the issuer has to have 80% of their business within the state. And I only sell it to residents of the state. We call that 80% rule for the issuer. And then I can only sell it to residents. Now, residents, after they've held it for 6 months, can sell it to someone else, but I only can sell it. Hence the term a interstate offering of securities. Right. So that's called Rule 147. I still have to register that with the state administrator through what's called qualification. Anybody know another one? You kind of were on the right track, I think. Another one is Reg D. Reg D is a private placement. Remember, we're not making a public distribution. Remember, 33 says if you're going to sell brand new securities to the public, you have to make a registration statement. In a private placement, we are not making or selling it to the public. We're only going to sell it to institutional investors. Your point might be a quib, a qualified institutional buyer. Somebody manages 100 million or more, or accredited investors. Very testable. What makes them accredited? $1 million net worth. Good way to remember it is 1, 2, 3. $1 million net worth, exclusive of their primary residence, or 200 grand for the last 2 years with the expectation of 200 grand this year, or married and filing jointly 300 indeed. Right. So, hey, good news for you. Also, Series 7s in good standing are accredited. So once you get this all done, you'll be able to participate in private placements. If you already weren't accredited, you will now be accredited. So Series 7s in good standing are also accredited investors. So good standing means not just your 7, you got to be the broker dealer. Okay, so assuming we don't meet one, by the way, it's important to understand that in this Reg D offering, what you're buying is unregistered securities. Because at some point, you know, you might want to sell these into a public marketplace, and there's going to be some rules about that. You know, so when you're buying, participating, you're getting unregistered securities. All right, so now we're going to talk about registering the securities. So once we make our registration statement, we enter into what's called the cooling off period or quiet time. You know, if we didn't have the cooling off period or quiet time, I'd be calling you every day saying, hey, Wendy, you know what IPO stands for, don't you? Instant profit opportunity. This thing is going to be hot. What I'm supposed to say is, Wendy, I'm not allowed to comment on the prospects of the issue. We're in the quiet time or the cooling off period, which is a minimum of, very testable, 20 days. That's very testable. Now, what I can do during the cooling off period, again, very testable, is I can send you a preliminary prospectus, also known as a red herring. And very testable, how is a red herring differ? How does a red herring differ from a final prospectus? How does a preliminary prospectus, a red herring, differ from a final prospectus? Right on, no final offering price. That's very testable. So it's got everything else, but that's pretty important, right? You know, so what's the price? What's the price? Now, based on that, very testable, we can accept indications of interest, which are non-binding on all parties. Indications of interest, which are non-binding on all parties. We're not allowed to advertise the new issue, but we can place a tombstone. I don't know if you're in a graveyard and you're looking at a tombstone. Usually there's birth date, when they died, loving father, husband, for more complete information to see the obituary. And that's very much what this tombstone says. It says this is neither an offer to sell nor a solicitation to buy the following security. An offering is made only by a copy of the prospectus. Read it carefully. Do not send money. What we're supposed to be doing during this process is what's called due diligence. Making sure that all the information we provided is truthful and relevant, not false and misleading. The biggest thing is to make sure we've made no omissions of material facts. No omissions of material facts. Very important word. Material means, it would alter an investor's decision. I saw this broker being interviewed and he was asked why he didn't tell the client this information. And he said, I thought I'd lose the sale. That is the worst all-time answer. I mean, that you're supposed to say, Wendy, it might alter your investment decision, but something you ought to know. Now, assuming we make it through this process, by the way, whenever there's three of a thing, if you're getting the idea of the test, what kind of a question should you expect when it says there's one of these? Hold on just a minute. I'm going to close my blinds here. That sun was coming right into my eyes. Oh, much better, much better. Okay, so where was I? You should stand by for the except question. All the following except, right? Your point about can't take orders, Wendy, right? Now, assuming we make it through that process, at the end of this is what's called the effective date. Please note the effective date. Did you catch the word I didn't use? The effective date. Did you catch the word I didn't use? On the front page of every prospectus, in big, bold, all caps, it says, very testable, the SEC neither approves nor disapproves of any securities offering. They neither pass upon the adequacy or the accuracy of the information contained herein. Any claim to the contrary is a criminal offense. Wow. There are two nasty words we never use in the securities industry. We never use the word approve. Anybody know the other word we never use in the securities industry besides approve? What's the other nasty word? We never use the word guarantee, right? If you want to hear the word guarantee, you need to talk to a banker about a banking product or an insurance about insurance products, because they can use the word guarantee. In the securities industry, there are no guarantees. Now, let's suppose, Wendy, that I wasn't able to get you an IPO allocation. And you say, Dean, can I still buy it in the secondary market? In the secondary market, secondary transactions is where the previous owner receives the proceeds. And that's all those transactions together are called the secondary market. And the two major secondary markets, market centers, are New York and NASDAQ. And so let's say this company is going to be trading on NASDAQ. And you say, hey, Dean, let's go into the secondary market and let's buy 1,000 shares there. And I want to do it in my margin account. So can you buy a new issue in your margin account? Can you buy a new issue in a margin account? The answer is no. Right? Reg T says that new issues cannot be purchased. Reg T is Federal Reserve Board, part of 34. And that says the Federal Reserve Board says we can't extend credit on new issues. So you call me, you say, hey, Dean, there's this company went public a while back, and I want to pick it up in the secondary market in my margin account. I say, how long ago did it go public? And you say, does it matter? I go, yes, it does. So test question, how long is it considered to be a new issue? How long is it considered? It's 30 days. So you say, Dina went public, 2 weeks ago, it's got to be in your cash account. You got to pay in full. You say 6 weeks ago, I go, no problem. You put up half, we'll loan you half. Now, as an investment banker, when I'm taking a company public, I say, while we're doing this registration statement, we should also do a shelf registration. Let's tell the SEC that we might want to come back and raise some additional money. It's better to have a registration on the shelf at the SEC and not need the securities than to need the securities and not have them. So if we do a shelf registration, that means moving forward, we can do what's called take down our shelf to sell additional stock for money or to make acquisitions. And if we are a WIXI, a well-known seasoned issuer of securities, our shelf registration would be good for how long? So how many years can I come back and raise some additional money? I can come back for up to 3 years. That's called a shelf registration. So, we take down our shelf. Typically company goes public, raises some money. They come back later on. They do what's called a follow-on. Or another time, the way we say it is an additional offering. All right, let's just look this over here. I think that's a pretty good overview, Wendy, of that new issue process, I don't see any gaping holes in what I have on the whiteboard. Wixie, I don't know, Wendy. That's the problem with using Dean, right? I teach 24s and 9s and 10s, and Wendy, we had some 9s and 10s floating around in the live stream tonight. So I think it's low probability. I think it's very low probability. But the rest of the stuff is pretty spot on. Anything else in there before you want me to bring up this QID? Is there anything else you want me to add to this, or any questions you have about this process? By the way, the process for the munis is very testable. So if the muni is underwriting this, right, the muni is going to have the municipality. Let's just go there real quick. It's a little different process for a municipality. So a municipality would hire a financial advisor. At a lot of firms, we have corporate finance, men and women who raise money for municipality or corporations. Corporate finance, a lot of firms have what is called public finance, men and women who raise money for municipalities. There's 50,000 municipal issuers of securities with $4 trillion in debt outstanding. And so the municipality might hire a financial advisor. That's a firm that would advise them on the best way to proceed to raise money. And remember, they would be either selling GO bonds or they would be selling revenue bonds. And they would be doing this on a negotiated basis or a competitive basis. Now, that's the two types of underwritings there are. So that's how they would proceed. In a negotiated underwriting, the issuer selects the underwriter. I think the closest analogy probably would be like getting a mortgage. If I want a mortgage, I go into my bank and I say, I need a mortgage. They say, you're going to shop around. I go, no, I expect you to give me a good deal. But if you don't, you're jeopardizing this relationship I have with the bank. Or I say, don't kid yourself. Yeah, I'm going to shop around. Whoever gives me the best deal, that's who I'm going to do business with. Competitive means they're going to put a notice of sale and the daily bond buyer and say, attention, investment bankers, we would like some help. And that notice of sale on the bond buyer, all those firms would then form syndicates to bid on the bonds. And the syndicate that's going to win the underwriting is the one who provides the issuer with the lowest net interest cost. Now, there's going to be some things that the syndicate would probably want to know. One thing the syndicate might want to know about is what's called test question, the legal opinion. Very testable. The legal opinion is done by a bond counsel. Very testable. And the bond counsel is either going to give us a qualified or unqualified legal opinion. What's better, qualified or unqualified? What's a better legal opinion, qualified or unqualified? What is preferable? No, it's counterintuitive. Qualified is bad because that means they have reservations. When your attorney says, I have to qualify this, that means they're telling you now the bad news. And unqualified is better. That means without reservations. So unqualified is good. And qualified is bad. Okay, so they're going to opine about the legislative authority to borrow the money. They're going to opine that the bonds are federally tax exempt. That's the number one reason that people buy municipal bonds. And they're going to opine that they're exempt from 33. Remember that? That means there's no prospectus requirement. So that's what they're going to opine about. Now, as a financial advisor, maybe they say, hey, Dean, can you bid for the bonds? I say, absolutely not. The MSRB, the Municipal Security Rulemaking Board, prevents me from changing my role as your financial advisor to becoming an underwriter. And so that's very tough. We can't switch your roles from being a advisor to an underwriter. The MSRB thinks that it's too much of a conflict of interest for the broker dealer to represent the issuer, the city, represent itself, and then represent its clients in a one transaction. And so they say you can't do all those things. You know, corporates, we can do that, but not in municipals. So I can't switch my roles. All right, so we have some documents we were talking about. We have our notice of sale here. We have the bond buyer here. You know, the one thing we don't have here is what's called the trust indenture, and we certainly would be interested in that as well. The trust indenture is the promises, the covenants between the issuer and the trustee for the benefit of the bondholder. Trustee is typically a commercial bank. FBO means for the benefit of. And these covenants are promises. These covenants are promises. One of the ones we would want to know, particularly in a revenue bond, is the promise a net revenue pledge, if it's a revenue bond, or is it a gross revenue? The net revenue test question, you know, this is called the flow of funds. In other words, when we're collecting tolls for the bridge or gate fees at the airport, where does the money go? And the test question is under net revenue, the operations and maintenance fund has priority. So that's where the money would go first. And then after that, it would go to debt service. And they'll say on the test, which fund has priority? You know, we'd also find, you know, call provisions and put provisions, and where there's a catastrophe call, all that kind of stuff would be found in this thing. All right, so the syndicate wins, and then remember the syndicate is going to have members of the syndicate, and then there's going to be what we call selling group members. You know, depending on who you are, will depend on, you know, how you get paid and what your risk is and all that kind of stuff. Any other questions on this before I bring up that QID to show it to you? You know, almost everything on that whiteboard is pretty testable. Munis are a big part. So remember the big areas on the test are munis, options, and mutual funds. So make sure you do that. Okay, so let's see your question. Your QID was 131. Okay. You're testing my prowess on being able to bring up something. So I think I can do this. Just waiting for it. When did it come up? Loading, loading, loading. Keep those questions loading. Okay, I think I got that up. Let me go back to you. Let me get the QID number. One, 3, 1. Okay.